Most beginners memorize chart patterns like shapes. Professional traders read them as behavior because every chart pattern is really just a visual representation of pressure between buyers and sellers. A chart pattern alone does not move the market. What matters is the story behind the pattern, momentum, liquidity, trap traders, and where the pattern forms in the overall market structure. For example, a bullish pattern forming inside a strong downtrend is very different from the same pattern forming at major support with higher time frame confirmation. Context changes everything. Pattern work because market move in a cycles, expansions, pullback, consolidation, breakout. And chart patterns are simply repeated structures created by human behavior, fear, greed, and liquidity. But here is the mistake many traders make. They trade patterns blindly. They see a triangle, wedge, or double top and enter immediately without confirmation. Professional traders usually combine pattern with confluences like market structure, trend direction, support and resistance, liquidity zones, volume or momentum, session timings, and candle confirmation. The more quality confluences you have, the higher the probability of the setup, not certainty or probability. And another important thing, no chart pattern is 100% reliable. Even the best setup fail sometimes because trading is a probability game, not prediction game. That's why risk management matters more than finding a perfect pattern. A good trader is not someone who wins every trade. It is someone who manages risk well while consistently following a high probability process. Most chart patterns are not magic prediction tools. They simply reflect shift in buyer and seller behavior on the chart. And reversal patterns are important because they can signal when momentum is weakening and a trend may be changing direction. The first one is the head and shoulder pattern. That's very common pattern. This usually forms after an uptrend. Price creates a high, pulls back, creates a higher high, called the head, then fails to create another strong high and form the second shoulder. What matters most is the neckline. A confirmed break of the neckline is what traders watch, not just the shape itself. And a volume or momentum weakness during the head can add more confirmation. The opposite version is the inverse head and shoulder. This forms after a downtrend and can signal a possible bullish reversal. Again, the neckline breakout is more important than trying to predict the pattern too early. Then we have the double top. This happens when price tests a resistance area twice but fails to break higher. It shows buyer may be losing strength. But the pattern is only confirmed when support between the two tops breaks. The double bottom is opposite. Price tests support twice and struggles to move lower, showing sellers may be weakening. Confirmation usually comes after the breakout above resistance between two bottoms. One important thing, and that's really important thing, especially for the beginners. Beginners often enter before confirmation because they are afraid of missing the move. Professional traders usually wait for the structure break, candle confirmation, momentum, or retest before entering. Pattern alone are never enough. Always combine them with market structure, trend, context, liquidity, support and resistance, and the risk management. The next very common pattern is the continuation patterns are not about trend reversal. They usually represent a temporary pause in the market before price potentially continues in their original direction. Think of them as a market taking a short break before the next move. The bull flag usually appears during a strong uptrend. First, price make an aggressive move upward, called the flagpole, then starts pulling back slowly in a small channel or range. What traders watch is the quality of the pullback. If the retracement is weak and controlled, it often shows buyers are still in control. The real confirmation comes from the breakout, not just the pattern shape. The bear flag is an opposite. Strong bearish move first, then a weak upward direction or correction. If sellers step back in and price breaks lower, the downtrend may continue. Then we have the ascending triangle. This pattern usually shows increasing buying pressure. Price keeps making higher lows while resistance stays relatively equal. That means buyers are becoming more aggressive around the same resistance zone. But important details, resistance must actually break for confirmation. Many triangles fail because before the breakout, especially in a weak market conditions. The symmetrical triangle is a different because both sides compress toward each other. Higher lows and lower highs create pressure from both buyer and sellers. This usually means volatility is tightening before expansion. A symmetrical triangle itself is neutral. The breakout direction is what matters. That's why experienced traders wait for confirmation instead of guessing early. And remember, continuation patterns work best when they align with the higher time frame trend, momentum, and market structure. The pattern alone is never the full reason to enter the trade. Breakout patterns are important because they show sometime the moment where the market is building pressure. But one thing beginners must understand, not every breakout is real. A lot of breakouts are actually liquidity grabs before price moves the opposite way. The falling wedge usually forms during a downtrend or pullback. Price keeps making lower highs and lower lows, but the selling pressure starts slowing down and the range becomes tighter. This often signals bearish momentum is weakening. When price finally breaks above the wedge and strong momentum, traders start watching for a possible bullish continuation or reversal. Then we have the cup and handle pattern. The cup shows a gradual recovery after a drop, and the handle is usually a smaller pullback or consolidation near the resistance area. What matters most is how price behave near the breakout zone. Strong breakouts with momentum and volume are usually more reliable than weak, slow breakouts. Now, the rising wedge is interesting because many traders misunderstand it. Even though price is moving upward, the trend is often losing strength. Price still makes higher highs and higher lows, but momentum becomes weaker and move starts compressing. A break below the wedge can signal bearish pressure entering the market. That's why rising wedges are often considered bearish pattern, especially after strong uptrend. One important thing for all breakout patterns, wait for confirmation. Many traders enter inside the pattern and get trapped by fake breakouts. But professional traders often wait for breakout, candle close, momentum confirmation, or even a retest before entering. Patterns are only part of the story. Market structure, liquidity, trend direction, volatility, and risk management always matter more than the pattern alone. Most traders look at the head and shoulder pattern as just another shape on the chart. But professionals look deeper. They see a shift in momentum and control between buyers and sellers. The head and shoulder pattern is a bearish reversal pattern that usually forms after an uptrend. It often signals that bullish momentum is weakening and the market may be preparing for a reversal. The pattern has three main parts: the left shoulder, the head, and the right shoulder. Price creates the first high and pull back. That becomes the left shoulder. Then buyer push the price to a higher high, creating the head, but after another pullback, buyers fail to create a stronger high and the right shoulder forms. And that failure is important because it can show that buyers are slowly losing strength. Now, one of the biggest mistakes beginners make is entering too early. The pattern is not confirmed just because the shape appears. What traders really watch is the neckline. The neckline acts as support, and when price breaks below it with momentum, that's when the pattern becomes more valid. Also remember, context matters. A head and shoulder pattern forming at a major resistance zone with a weakening momentum or bearish divergence is usually much stronger than a random pattern in the middle of the market. And like every setup in trading, this pattern is not guaranteed. False breakout happens all the time. That's why professional traders combine chart pattern with confluences like market structure, volume, momentum, liquidity, and proper risk management. So don't just memorize the pattern, understand the psychology behind it, because the real edge is not the shape itself. It's understanding what the market participants are doing inside the pattern. Double tops and double bottoms are some of the most common reversal patterns in trading, but the real meaning behind them is market rejecting and weakening momentum. A double top usually forms after an uptrend. Price tests a resistance area twice but fails to break higher. That failure can signal buyers are losing strength and seller may start gaining control. A double bottom is opposite. Price tests support twice and struggle to move lower, showing selling pressure may be weakening. One important thing, the pattern is not confirmed just because two highs or lows appear. Confirmation usually comes after the neckline or support resistance level breaks with momentum. And like every pattern, context matters. Double tops and bottoms become stronger when they align with market structure, key levels, momentum shift, and higher time frame confluence. So don't trade the pattern blindly, understand the rejection, the liquidity, and psychology happening behind the chart. Flags and triangles are continuation patterns, which means the market is usually just pausing before deciding its next move. A flag pattern normally happens after a strong move up or down. Price starts consolidating in a small channel, almost like the market is taking a short break before continuing the trend. Triangles are little different. Price starts compressing between support and resistance, creating pressure as buyer and seller fight for control. One important thing, don't try to predict the breakout too early. A lot of traders get trapped guessing direction before confirmation happens. The best setup usually happen when the breakout align with trend direction, momentum, volume, and overall market structure. So instead of just seeing shapes on the chart, try to understand what the market is actually doing, consolidating, building pressure, and preparing for expansion. Wedges and cup patterns are popular because they can signal strong breakout opportunities, but only when trend is in your favor or when the trend is in the favor of the shapes of the pattern. Let's start with the wedge pattern. A falling wedge usually forms when price is still moving down but bearish momentum starts slowing down. The range gets tighter, volatility compresses, and eventually price may break upward. A rising wedge is often because the opposite. Price keeps pushing higher, but momentum becomes weaker and breakdown can happen. For entries, many traders wait for confirmed breakout candle outside the wedge instead of entering inside the pattern. More conservative traders wait for the retest after breakout. Stop loss is usually placed outside the opposite side of the wedge structure to protect against fake out breakout. And take profit can be targeted at the previous high or low, major resistance support, or measured move projection. Now let's talk about cup and header pattern. The pattern usually forms during bullish continuation. The cup represents recovery and accumulation, while the head is a smaller pullback before breakout. A common entry is above the handle breakout when momentum confirms the move. More experienced traders also watch volume increase during breakout for extra confirmation. Stop loss is commonly placed below the handle low or recent support area, and take profit is often estimated using the depth of the cup projected upward from the breakout zone. But remember, again and one more time, no pattern is guaranteed. The strongest setup happens when patterns align with the market structure and other confluences like risk management, momentum, liquidity, and the terrain interaction. Join our Discord community for more trading education, market discussions, and learning resources. Scan the QR code on screen to join. And one last important information. This content is provided for educational and informational purposes only and should not be considered financial, investment, or trading advice. Trading financial market involves significant risk and losses can exceed deposits. All trading decisions are made at your own risk. We do not guarantee profits, income, or specific results. Past performance does not guarantee future outcomes. By using this content, you acknowledge full responsibility for your own trading and financial decisions.